In this video, we're going over what risk and return to aim for when trading credit spreads. Before I get into the weeds and go into an options chain, I want to show you specifically what numbers you want to target and why. So first off, you need to know what strategy are you using. The strategy we're using will determine so much. And so again, let's say you went to the link in the description below this video, checked out the free trading handbooks guide, and used one of those strategies. On average, they have a 95% win rate. Okay, cool. So for the sake of this video, we're going to use a 95% win rate as our ideal approach. So again, this is all based on the strategy that you're using. And again, I'll even show you at the end of the video how to determine your strategy based on these numbers as well. So anyways, you can see here, let's say we have a 95% win rate. So that means we need to be over this. So this table shows the win rate you need in order to break even based on your risk to return. So for instance, right here, if you're risking $1 to make $3 or risking 1% to make 3%, you need to have at least a 25% win rate to break even. Anything above that means you're going to win money long term. Now, credit spreads have the inverse relationship because by default they're naturally higher, a higher win rate. So again, if you're risking $5 to make $1, then what's going to happen is you need an 83% win rate to break even. So you win a lot more. Or again, if you win a lot more, then you can change that risk to reward. Now again, if I'm trading with a 95% win rate, I want anything below this number. Anything below a risk of 10 and a reward of 1. Anything below this will yield a super positive long-term return, right? Anything above or 50 above, I would be losing money because I have a 95% win rate. Okay, so that's ideally what we're looking for. It's our risk to return. So this is what we will be looking for. Let's say 10 to 1 or 5 to 1. Let's just go 5 to 1. A 5 to 1 is a 20% return on the risk that we have. Okay, essentially that's what we are looking at. You can either have a 10 to a 20% return on the risk that you have. That will come in handy here after I talk about this table. This table is very important. A lot of people overlook this step and don't know this math. It is the probability of a certain amount of losing trades based on your win rate. Okay, so a 95% win rate, we have a 99% chance of having one loss. We have a 22% chance of having 2 losers in a row. We have a 1% chance of having 3 losers in a row. And anything more than that, it's very, very, or almost 0% likely that we'll have any more than 3 losers in a row. And so again, this is statistically how it plays out. You can have more than this in real life trading, but statistically, you should expect no more than 2 to 3 losers in a row with this. What does this mean? Well, it helps you understand and define your risk, right? If you're risking $2,000 per trade, can you handle 4 losses in a row? Well, $2,000 per trade, 4 losses. Can you handle an $8,000 loss before you start making money again? That is the question here. And so again, when you put this into perspective, maybe you can't handle an overall $8,000 loss. You should change what your max loss should be. So for instance, let's say you're comfortable with a $4,000 max loss and you can have up to 4 losses in a row, then that means you would want to risk no more than $1,000 for each trade. Okay, cool. Now let's take all these numbers we just discussed and show you how it actually applies. Okay, cool. Remember here, we're looking to have a 10% of the risk or 20% of the risk for our return. Let's take a look at what that looks like. So for instance, let's go out about 18 days. Let's come here to put on a put credit spread because in general, the market looks like it's moving higher. So I think it's just going to continue to move higher. So again, I'm going to go here. Let's say we're going to sell this one and buy this one. Okay, let's look. Right here, a limit price of 7 cents, credit of 7 cents. Okay, how much money am I putting up for these 7 cents? Well, again, you can see here my options order default to 10 each. Let's go and default to 1 just for easy math. Okay, so I have a chance to make $7 with a risk of 93. Okay, cool. So let's simply do that math. Like I said, we need between 10 to 20%. 20% being greater than 10% for the overall return. Anyways, how do we do this math? We do 7 divided by 93. That gives us, and I guess you multiply 100 if you want to get the actual percentage number, 7.5%. Okay, not really what we want, so we have to move this trade a bit closer. 433, 432. Now we're at an $11 max profit with an 89 max loss. So let's see, what does this give us? 11 divided by 89 times 100. That gives us a 12.35%. This is us swinging in the ball range of the risk to return that we want, to have the win rate that we have, or to keep the win rate that we have. And this is kind of how you put that trade on. You can see here a probability of 83% and a profit of 50% of 94%. So again, this kind of lines up with the math that we're talking about. But when you put it with the strategy that we use, your 83% win rate bumps up a few points, bumps up about 7 to 10%. So now we're jumping around a 93% win rate because we're trading in the direction of the trend. When you trade credit spreads in the direction of the trend, this probability number increases. Anyway, so this is what you would know, what you would want to pick. This would be the strike prices for the put credit spread in order to have that type of risk to reward setup, which would give you the long-term win rate. All right, I hope I didn't put too many numbers in front of you, but I wanted to show you guys it all comes down to what do you want your win rate to be, or what is your win rate. When you know that number, then you can define what your risk to reward will be. Then you use that risk to reward to pick the proper credit spread for you. So again, that's one way to pick credit spread strike prices, understanding your risk to reward. All right, guys, that was this video on what risk and return to aim for and what that looks like when applying it on the options chain. I hope that answered your questions. If you have any questions, please comment them down below. If you enjoyed this video, smash the thumbs up button and subscribe button, as I post videos every single day to help you become a better credit spreads trader. All right, guys, see you in the next video.